자, 이번 시간에는 스탁마켓의 몇 가지 스타일라이즈드 팩터들에 대해서 보도록 하겠습니다. 먼저 이제 타임 시리즈 팩트들에 대해서 볼 거고요. 즉 이제 전체 스탁마켓을 시계열적으로 어떻게 분석하는지, 그리고 어떤 결과들이 나와 있는지와, 그 다음은 이제 크로스 섹셔널한 팩트들이에요. 즉 어떤 주식이 다른 주식보다 리턴이 높고 낮은 거에 대해서 어떠한 사실들이 알려져 있고, 기존의 모델들이 어떤 식으로 설명하고 있는지에 대해서 알아보도록 하겠습니다. So the first thing I will talk about is the return predictability. According to the efficient market hypothesis, returns are very difficult to predict, but it is well known that statistically and also from the empirical evidence that stock returns are predictable, especially the long horizon returns are predictable. So here are some of the regression results. On the left hand side is the long horizon return. So this is K horizon return. On the right hand side, you have the dividend to price ratio. So dividend to price ratio can explain the long horizon return, as you can see from the R squares and the regression coefficients. Okay? And look at the standard deviation, standard errors of the estimators. So these estimators are, you can see that two standard deviations away from zero. So these coefficient B's are estimated to be significant, and also R squared can be very large. Okay. So returns are predictable using price to dividend ratio here, especially long horizon returns are more predictable. So low prices relative to dividends, meaning low price to dividend ratio, can forecast high subsequent returns. So 1 year horizon R square is not very high, but at longer horizons, larger and larger fractional return variations are forecastable, as you've seen in the previous slide. Can use other divisors as well. For example, you can use earnings, book value, moving average of the past prices, and so on and so forth. Many other variables are known to predict future returns. For example, the term spread, which is the long minus short-term bond yields. This is a very powerful predictor of the future returns. Default spread, this is triple B minus triple A credit spreads. TBO rate, this is the short-term rate, the risk-free rate, and earnings to dividend ratio, and consumption to wealth ratio. These can all predict future returns. And this is the evidence from the CAY, which is the consumption to wealth ratio, price to dividend ratio, dividends to earnings ratio, and this is risk-free rate, detrended risk-free rate. As you can see, across many horizons, R scores are very high. In other words, returns are predictable, especially long horizon returns are predictable. In other words, it might be difficult to predict tomorrow's return, though it is easy to predict 6 years after. So the natural explanation for this fact is that expected returns vary over business cycles. So it takes a high risk premium to get people to hold stocks at the bottom of the recession. In other words, during the during the market crisis times, it requires a lot of risk premium to hold people to get people to hold stocks, and those who purchase stocks at the market crash can earn a lot of money. In other words, when expected returns are high, prices go down. When you see low prices, that is because the market requires higher expected returns. You should also note that regressors do not have to have causes on the right and effects on the left. In other words, the regressions that you saw in the previous slide is not about the causality. Okay? It just shows that what predicts what. Okay? So it's like regressing future weather on expected weather, but that doesn't mean that expected weather predicts future weather. And that doesn't mean the expected weather cause future weather. And also, it is important to note that excess returns are forecastable. Okay? So in other words, so predictability is reward for risk, not reward for the interest rates. In other words, if you look at the return components, right, there are two components, the, the risk-free rate and the market, and the predictability is not working through, it is not working through the risk premium, I'm sorry, risk-free rate channel. So the results at different horizons are not separate facts, but it's a reflection of the single underlying phenomenon. What's the meaning of that? Daily returns might not be predictable, okay, but this predictability adds up over long horizons so that long horizon returns are predictable. So if you can predict just a little bit of today's return and a little bit of tomorrow's return and so on and so forth, over time you can predict a lot. It is almost like, oh, it is very difficult to predict tomorrow's temperature, but you can predict pretty much what the temperature is going to be after 6 months. Okay, so if you say in January, you can predict the temperature in July. In July, the temperature is going to be much higher. Okay, so the central fact that drives the predictability of the return is that the predictor or the dividend price ratio in this case is very persistent. So predictors are usually persistent. Again, this predictability across different horizons driven by persistence in predictors. Daily returns only slightly predictable by slow-moving variable, but predictability adds up over long horizons. And this is the graph of the price to dividend ratio. AR1 coefficient is almost close to 0.9 in an annual data. We can understand this long horizon predictability using some model. Let's consider the following model. The return is driven by the expected return. So this beta times xt is basically the expected return. And this expected return follows a persistent AR1 process. Now, you can express the longer run horizon returns, say 3-period returns, can be expressed as three things. Two things. Three things, I'm sorry. The first one is the persistent component. The other things are the shocks to the expected return and all the shocks to the returns itself. And the key here is that, first of all, because rho is close to 1, because expected return is a persistent variable, therefore, this coefficient, in other words, b plus this one increases with the horizon. In other words, returns are more forecastable over longer horizons. The other thing is that these errors here, although there are many different terms, they tend to be uncorrelated over time. So they tend to offset each other. So in terms of R square, the predictability also goes up. Now, there are studies of excess volatility. In other words, how come 20 or 30% of the stock market wealth change in a year without accompanied by any big news about future cash flows? Is it driven by irrationality of the market? Think about it. If the market collapses by, say, 20% over a month, how come is it possible that 20% of the wealth of the economy is destroyed just in 1 month? A lot of people say that this is the evidence of irrationality, but this can be also driven by the return predictability. So even when the market is rational, this kind of excess volatility can happen. Okay. So high price to dividend ratio can imply that investors expect dividends to rise in the future, or investors expect returns to be low in the future. And the third possibility is about the bubble, but we don't have to consider it here. Okay? So we can understand that using the Campbell-Shiller decomposition that we learned in last time. So the price to dividend ratio has two components, the cash flow component and the dividend discount rate component. Okay. In other words, if the price to dividend ratio is too high, it means that either the firms in the economy are going to make a lot of money. In other words, the cash flow component is high, or it can be driven by the discount rates are too low. Investors are too optimistic that the risk of the economy is low, therefore discount rates are low. And it is known that the excess volatility is typically driven by the discount rate component. So even though firms in the economy, the cash flows do not change over time, do not change much over time, if the discount rates change a lot, then it can explain excess volatility in the stock market. Some people say that you should hold a stock for a long run because returns are stable over long horizons. So what's the meaning of that? You can express one period return like this and also long horizon return if you use log then as a sum of the single horizon returns, right? Suppose that the returns are a random walk. And now take a look at log 2 period return. 2 period return is basically sum of the one single period returns. And let's just assume that expected return of the log 1 period return is same across all periods, all right? So if you look at 0 to 1 year return or 1 to 2 year return, the expected values are the same. Therefore, expected log return over long horizons increase with the horizon. Okay? Same thing for the variance. If you assume the random walk, this covariance term is going to be 0. The variance also increases over time with horizons. Okay? Now, what is the diversification here? The diversification is that this covariance is 0. In other words, the shock, so you will have two periods, right? So each period you will have return shocks, right? And these return shocks tend to be uncorrelated. Therefore, if you hold the return over longer horizon, then these errors tend to cancel each other. Therefore, standard deviation. Variance is going to increase linearly, but then the standard deviation is going to increase with square root of the time horizon. Therefore, if you look at the Sharpe ratio, what is the Sharpe ratio? Sharpe ratio is the expected return over standard deviation. Okay, this increases with square root of t, okay, because expected return increases with t. Let me rewrite it. Expected return increases with t, standard deviation increases with square root of t, therefore it increases with square root of t. Therefore, if you hold stocks over longer horizon, the Sharpe ratio is going to increase. So what is wrong with that? Well, it matters about the annualization. Okay? So if you look at the return over one horizon, then it doesn't matter whether you hold it you hold it 1 month or 2 months. Let's consider this, right? So if you look at the annualized return, okay, so if you consider annualized 2-year return, then you have to divide by 2. Okay? So the expected return is the same as the 1-year horizon. If you look at the variance of the annualized 2-period return, then you have to divide by 2. Okay? So in other words, the mean of the annualized return is the same as the horizon gets longer, but the variance of the annualized return goes down as the horizon gets longer. But what matters for us is the total return, not the annualized return. So individual stocks show some small negative autocorrelation that is known very well documented. In other words, daily, weekly, and monthly horizons. If you fix a stock and look at the autocorrelation, the autocorrelation tends to be negative. In other words, stock returns tend to over-respond. But if you look at the broader stock returns, the returns tend to be positively autocorrelated. And this is typically explained uh, by the asynchronous trading, okay, which drives the positive autocorrelations. In several month horizons, both individual stocks and broad stock indices also both have positive autocorrelations, but then in the longer horizons, the autocorrelation tend to be negative. So in other words, the shorter horizon positive autocorrelation is related with momentum, whereas longer horizon negative autocorrelations are related with reversals. Now, to test the negative autocorrelation, people use the variance ratio test. In other words, at the index level, returns are negatively autocorrelated at longer horizons because of reversal. In other words, variance ratio does not increase linearly. What is the variance ratio? That's the variance of T horizon return over T times variance of the return. And if returns are random walk, this should be constant. The variance of the T horizon return shouldn't increase with T, but it is known otherwise. In other words, normalized variance ratio is basically the T horizon variance divided by T, and you can see that this one decreases. In other words, if you compare the T times variance of the return and the long horizon variance, the numerator does not go up much in comparison with the denominator, right? So the long horizon variance tends to be smaller than the T times variance of the return. In other words, long horizon returns tend to be safer because of the negative autocorrelation or the reversal in the stock market. Now, we can also understand these autocorrelations using the Campbell-Shiller decomposition. The computation is a little bit complicated, but you can take a look at the textbooks. So let's just suppose that, similar as before, the conditional mean follows the persistent AR1 process. Now you can use the Campbell-Shiller decomposition and plug these into the Campbell-Shiller decomposition, and you will get the following. Now, the discount rate component is going to have the two part, right? So one part has the constant, the other depends on the expected return, conditional expected return of the market. Now the variance of this component, the discount rate component, is going to increase as rho becomes close to 1. Okay, so I'm sorry, the phi is close to 1. What is phi? Phi is the autocorrelation of x. So x becomes more persistent. The variance component of the discount rate is going to be greater and greater. So even though cash flows are not very volatile, even though a firm doesn't have very volatile cash flows, the variance of the stock return can be very high if the conditional expectation is very persistent. In other words, the market can collapse, or market can just goes up like very much, even when cash flows do not change much, but it can all be driven by discount rate component. Okay, let me skip this part. Let's move on to the cross-sectional stylized facts. So the research in the cross-sectional asset pricing all begins with the CAPM, the one-factor capital asset pricing model. Now, the traditional way of testing cross-section asset pricing model is the following. Let's just find a characteristic that you think is associated with average return, say book to market or momentum or PE ratio and so on. Then sort stocks into portfolios based on these characteristics and check if there is difference in average returns between these portfolios, compute the betas and see whether these betas can explain the return differences. And if betas cannot explain, then you have what is called the anomaly. In other words, anomalous return phenomena that cannot be explained by the CAPM. And in the earlier data, the CAPM used to be good. In other words, betas can explain the average excess returns, but then it is known that many characteristics cannot be explained by the beta, one of which is the value effect and the size effect. Okay? And then came the Pharma French three-factor models to explain the value and the size effect. Okay? So one of the most popular multi-factor models, it used to be the case, that is the Pharma French three-factor model. And mainly the Pharma French three-factor model is trying to explain the value effect. So what is the value effect? Value stocks have market values that are small relative to the book value. These stocks have large average returns. That is the value effect. Growth stocks are the opposites. Growth stocks have high market value relative to the book value, and they have low average returns. High average returns are consistent with the CAPM if these high returns can be explained by the betas, but the answer is no. If you look at the excess return of the so-called 25 book-to-market and size-sorted portfolios, then you can see that there is basically no relationship between beta and the excess returns. So this is the failure of the CAPM. Then this CAPM is not explained by the size alone because you can see that this value effect exists across all size categories. Okay, so these are the different, if you look at these, they represent different size categories, but you can see that in any of these size categories, beta can explain expected returns. Now, Pharma and French, upon observing these anomalies, they advocate a multi-factor model. Especially, they propose this three-factor model: market factor, small minus big stocks, which is the size factor, and the value factor, which is high book to market minus low book to market stocks. And they show that variation in average returns of the size and book to market portfolios can be explained by the loadings on these two latter factors. Okay? In other words, the SMB and the HML factors. And this is the result of the Pharma French three factors. You can see that now the predicted expected return from the Pharma French three-factor models and the average returns tend to line up very nicely. Okay? So when the book-to-market betas or the size betas are high, returns tend to be high as well. Then comes other anomalies, which are momentum and reversal. Reversal is usually you use 1 to 5 year portfolio formation periods. In other words, look at past 1 to 5 year returns and then consider the return for the next year. Okay? And momentum is like you form portfolios based on the last year's return and then form momentum returns. So the procedure is the following. So each month, sort stocks, rank stocks based on, say, momentum. How is momentum calculated? Using the past 2 to 12 months returns and rank the stocks. Highest return stocks lowest return stocks. Okay. So rank the stocks based on the past performance during the past 12 months, and then you can form portfolios, say winner portfolio and loser portfolio. Winner portfolio are the stocks with the highest past returns. Loser stocks are the stocks with the lowest past returns. Momentum is the phenomenon. Okay, momentum is the phenomenon that high past return stocks or winners will continue to have higher returns in the future, whereas reversal is the other way around. Okay? So what is the strategy? Each month, you rank stocks to 10 portfolios based on the performance in the past 5 years. The best performance and the worst performance, we will compare them. Best performance, so even though their past returns are time zero here, even though their past returns were good, their future returns are going to be bad. Worst performers, even though their past returns were bad, their future returns are going to be good. In other words, past long-term losers, they will come back, whereas past winners, they will do badly. And Pharma friends show that this reversal effect can be explained by there are three-factor models. Why? Because this is very similar to the book-to-market effect. Then comes the momentum. Momentum is the strategy that sorts stocks into 10 portfolios based on the best performance and the worst performance using the past 12 months returns. Okay, so compare with the reversal, the return measurement period is much shorter. Now, what it's saying is that past winners continue to do well, past losers will continue to do worse. And Pharma French three-factor model cannot explain momentum factor. Therefore, Carhart came up with this four-factor model that includes the momentum factor. Now, momentum factor requires frequent trading because it's a monthly rebalancing strategy. So transaction costs are very high. And Carhart calculates the transaction cost and concludes that momentum might not be exploitable after transaction cost. And also Moskowitz and Greenblatt show that most of the gains from the momentum strategy is coming from the short position in long illiquid stocks, means small and illiquid stocks, therefore their transaction costs are going to be very high. So the momentum is not an easy strategy to exploit.